Chapter 7, the once and future Federal Reserve, the Fed's banking functions. If we examine the manner in which the Bank of England has fulfilled these duties, we shall find, as we found before, that the true principle has never been grasped, that the policy has been inconsistent, that though the policy has much improved, there still remain important particulars in which it might be better, than it is. Walter Bagot, 1873. The framers of the Federal Reserve should not recognize the system right before the 2008 crisis. They may have had slightly easier time recognizing it in the months and years since. The reason for the change is that the Fed's original purpose, as its character suggests, was to furnish an elastic currency, to afford means of rediscounting commercial paper, to establish a more effective supervision of banking in the United States, and for the other purposes. These are largely the banking functions of the central banking and include three that became crucial to the conception of the Fed after the 2008 crisis. First, the Fed has acted as a lender of last resort in response to financial panic. Second, it has regulated all banks' participation in the financial system, although the tenor and scope of those regulations have changed dramatically over a century. And third, it has supervised individual banking institutions to ensure that they comply with its regulations. Together, these functions provide a way for merchants and bankers to get access to an international financial system while providing at the same time a break against crisis, both small and large, as a result of the financial crisis of 2008. Scholars and central bankers have begun to discuss the financial stability function of central banks in much more serious, comprehensive way. But this function isn't new. These functions define the Federal Reserve System at its inception. Despite this banking-centric history, one reason for the function seem new is because of how uncomfortably they fit within the Ulysses Punchbowl approach to Fed independence. It is a mistake, though, to think that the Fed's crisis response represents a deviation from the Fed's traditional functions. It is, in fact, the narrowness of the prevailing vision of central bank independence. That is the modern innovation. The crisis dusted off old tomes about the Fed's banking functions and made them stylish again. It is telling that when Walter Bagot wrote Lombard Street, conventional, more monetary policy that hadn't been invented yet. Today, Bagot's advice on central banking has become a Bible in these circles. The Fed has rediscovered its financial stability role and began an effort to understand how to reinvigorate it into an institution that had evolved differently. This chapter discusses the four aspects of this once and future Federal Reserve System and looks at the ways the Fed's disparate functions fit, or as it turns out, do not fit within the Ulysses Punchbowl conception of the Fed independence. The lender of the last resort function, bank regulation, the changing context of bank supervision within the Fed, had the advent of financial stability as a rival mandate to the Fed's statutory command to ensure price stability and maximum employment. Besides failing to fit within the prevailing lens of the Fed's independence, there is another sense in which the Fed's banking functions present a problem for Fed governance and accountability. Banking regulation and supervision in the United States are a jumble. It isn't a rational system. Political scientist Terry Moe may as well have been discussing in the fractured and fragmented world of financial regulation when he wrote that American public bureaucracy is not designed to be effective. The bureaucracy arises out of politics, and its design reflects the interest, strategies, and compromises of those who exercise political power. As we shall see, the same is true for the banking regulatory state. The original Federal Reserve, the lender of the last resort, we've already seen in Chapter 5, the Federal and Federal Reserve, is something of a misnomer. There's nothing really federal about it. What's about the reserve? This refers to both the Fed's traditional function as a lender of last resort and to the member banks' reserves that are kept in the entire system. Some thought the advent of other banking regulatory functions, namely deposit insurance, had cast the lender of last resort function into the archives of history. The 2008 crisis showed us how relevant the function remained. The idea of a lender of last resort is a simple one. In a banking panic, depositors show up in mass to withdraw their deposits, but as any fan of Frank Capra's It's a Wonderful Life could tell you, banking doesn't work that way. Banks operate on a fractional reserve, meaning the savers deposit money in the vaults that then goes to work to loan to spenders in the field. To oversimplify, fractional reserve banking in its traditional form follows the 3-6-3 model. Pay depositors 3%, lend out at 6%, and hit the golf course by 3 p.m. The business of turning short-term deposits, which savers can demand any time during banking hours, into long-term loans like 30-year mortgages or 10-year loans to a new business is called maturity transformation. This is the way that banks historically have made their money. Maturity transformation is what makes banks so vulnerable to failure. The system relies on an assumption that only a few short-term depositors will withdraw their money on a given day. When more depositors show up at the bank demanding even more and withdraws than is on deposit in the vaults, the bank will fail unless new cash can be secured. The first priority of a bank facing a panic then is to publicly and ostentatiously demonstrate that it has secured new funds, usually from another bank. As soon as the panic is stabilized, a bank with a well-managed portfolio will pay back both its emergency debts to the other banks that have stepped in the breach and those that the bank owes to its regular depositors. In the sometimes confusing vernacular of banking, the bank's assets include the loans it is to be owed by homeowners, business owners, and the like. Its liabilities include the deposits that savers can demand at any time. If the panic spreads, however, the usual sources of short-term credit to first scared bankers, other banks are themselves tied up to fend off the bank runs of their own. At that point, a localized panic has become systemic. In that event, banks scramble in a dash to find liquidity in the system. Wherever liquidity can be found, the central bank is the solution to the scramble for liquidity. The central bank is the lender of the last resort. Quotes, the bank that exists to restore order to financial system. The concept of lender of last resort, quotes, was first alluded to by the British banker Francis Baring in 1798, and then expanded on a great length by lawyer and economist Henry Thornton. But the concept received is his most famous articulation by Walter Bagot in the treatise Lombard Street, a description of money market. In Lombard Street, Bagot explained his view of the lender of last resort as one whose essential role is to keep the central reserve of cash and gold to be deployed richly and freely for the purpose of stemming panics. The advice is sometimes called Bagot's dictum. In a crisis, a central bank should lend freely at a high rate against good collateral. When this occurs, if the theory holds, the banking panic should stop. Bagot described what he had in mind most clearly in his famous passage. A panic, in a word, is a species of neuralgia, and according to the rules of science, you must not starve it. The holders of the cash reserve must be ready not only to keep it for their own liabilities, but to advance it most freely for the liabilities of others. They must lend merchants to minor bankers, to this man and that man, wherever the security is good. In wild periods of alarm, one failure makes many, and the best way to prevent the derivative failures is to arrest the primary failure which causes them. Of course, Bagot was writing at a different time from our own. In 1873, the date of publication, the world was beginning what scholars have called the classical gold standard that lasted roughly from 1871 to 1914. And in this era, for example, there was no such thing as government-sponsored deposit insurance, something that developed slowly during the late 19th century and only became more widespread after the Great Depression. In light of these developments, Begot remained a little more than the subject of scholarly conversation. Even there, the assumption was that Begot's principles of the lender had the last resort and had been made irrelevant by the adherent of deposit insurance. Once again, until 2008, deposit insurance had largely, but not completely, eliminated the concern of runs on banks by individual depositors, like the one seen as Bailey Savings and Loan. These local banks were far from the only participants in the financial system. Instead, the largest investment banks, some of which were not even under the regulatory purview of the Federal Reserve at all, were the ones exposed to risk and most likely to spread risk to others. In the spring of 2008, staff and leadership within the Federal Reserve faced what they feared to be a banking panic redux, but without the prospect of deposit insurance to mitigate it, since it targeted uninsured investment banks, insurance companies, money market funds, and other uninsured financial institutions, invoking emergency lending authority that had been unused for almost 80 years. The Fed picked up its lender of last resort quotes, function, and proceeded to deploy throughout the economy. This is the infamous 13(3) authority discussed in Chapter 4, the Fed's emergency lending of last resort functions, started with the investment banking giant Bear Stearns, and in the time extended to money market funds, traditional banks, and insurance companies. Bernanke self-consciously channeled the memory of Begot on multiple occasions. To say that some were uncomfortable with Bernanke's Fed invocation of the lender last resort function is an understatement. Some of these criticisms even cut close to the central banking bone. In a rare instance, a former Fed chair criticizing current Fed policy, Paul Volcker, in a public speech immediately following the Bear Stearns bailout, viewed the move as neither natural nor comfortable. For a central bank, articulating the Ulysses Punch Bowl view of the Fed independence, he explained that the Fed is granted a high degree of independence to pursue its duty, a custodian of the nation's money. In that role, the Fed should be removed from and be seen to be removed from decisions this seemed biased to favor particular institutions or political sensitive constituencies. The Volcker Fed, of course, was responsible for the modern revival of the too big to fail doctrine in its response to Continental Illinois in 1984. Volcker's view in the 2008 demonstrates how completely he and others have come to accept the Ulysses Punch Bowl theory of Fed independence.